Hello and welcome to CommBank View, Economics and Markets, where we unpack all the key drivers of what's out there in the economies and markets around the world every single week with, of course, CommBank's strategists and economists. My name is Mandy Drury and I'm always delighted to be your podcast host. This week, I'm talking with Adam Donaldson, Head of Market Strategy and Rates Research, and Dr. Madison Cartwright, CommBank's Senior Geo-economics Analyst. And we actually want to do something a little bit different, don't we, this week, Adam and Madison, because we want to take a step back from the short-term noise, which obviously does move the markets on a daily basis, but it also creates maybe a little bit of tedious news flow that we just don't need when it comes to trying to decipher what some of the longer-term structural influences are that guide interest rates. And that, in turn, also guides what's happening out there in economies and also asset market performance. So, Adam, let's kick things off with you, first of all, because in recent times we've been hearing a growing reference from the Reserve Bank of Australia to the neutral interest rate. Can you explain to us what exactly that is and why it's so important?
Yeah, well, the neutral interest rate is a bit like the goalposts that the RBA is aiming for when they're talking about whether monetary policy is tight or restrictive versus, say, loose. Or whether they're trying to inflate the economy or perhaps contain inflation. That's the goalpost against which they're referencing the stance of policy. So the neutral rate, another way to think about that is that it's an interest rate that is neither stimulating nor restricting the economy, a natural rate where things are settling down. And what's been very apparent over the past few years is that a long period where that neutral rate was declining, a 30-year period where it fell quite substantially, has reversed. And for 5 or 6 years now, it's become apparent that that neutral rate is rising. So the goalposts against which the RBA is assessing whether policy is tight, whether they're able to contain the current inflation pressures in the economy, they're moving, and we have seen that that's made them doubt whether they've done enough on interest rates.
So what are some of the key trends that you're ascertaining that's pushing up that neutral rate now?
Yeah, so as I say, it's been a big change in direction after a 30-year period where they were falling. When we go back and look at Economics 101, what we measure to think about interest rates is really global savings and global capex. The savings versus capital expenditure balance is an absolutely key driver of natural interest rates. And in a globalised world, Australia's rates heavily influenced by those trends internationally. So what we have observed is that after a long period where global savings were significantly above capex, that trend has reversed over the past 5 or 6 years, and now the capex spend is outweighing the global savings story. And that's driven by defence. So a spend that all nations are undertaking really is building. It's been driven by the transition to the net zero carbon economy, so a massive spend on capex that's effectively related to duplicating the world's energy systems. AI is another one that's come along recently, huge capex spend. And then you would also put in an element of fiscal discipline, just not being as strong as it used to be. And that change has changed the balance against which those goalposts the RBA needs to think about are shifting.
And we did a deep dive into the AI spending and global data centre build-out last week. Madison, getting to you then, because the CBA research team has been talking about this new era in the global economy for some time now. And the reason that your title is a geo-economic strategist rather than a geopolitical strategist is because you do look at some of the deeper economic causes of these political changes and priorities that Adam's just been talking about. So how do you think about the global environment when we take into account all the spending that Adam has just told us about?
Yeah, well, and forgive me, I am going to put a little bit of jargon in here, but and that jargon is hegemon. So since the end of the Second World War, the United States has been what we refer to as the hegemon, and this essentially describes a country that is not just more powerful than the others, but supremely powerful. And because of that position, it has a very large role in setting the rules of international commerce, but also stabilizing the international economy. And what's happening at the moment is the United States is losing that hegemonic position. It's not becoming, so no country is overtaking it in terms of power. The United States remains the most powerful, but it's losing this supremely powerful position. And this is creating an effect where the rules of the game, therefore, are up for grabs. They're shifting beneath our feet. This is because we have emerging challenges, most predominantly, of course, which is China, but also just a growing multipolarity. So we see Europe emerging as more autonomous and separate from the United States, but also the emerging markets becoming more powerful as well. And so everyone's trying to think, well, what are the rules of the game? And if the United States is not in a position to enforce them anymore, can we renegotiate these and renegotiate our position in them? The United States is also reconsidering these rules because they're not working for it at the moment, right? It's losing its influence and power. So it's starting to think, well, do we need different rules and different
What do you think the
ways?
main reasons behind losing that influence and power? What do you think the root cause of that is?
Well, it's sort of built within the system itself, right? The United States built this open, free exchange, free trade system, right? Not perfectly, but I mean, that's broadly the spirit of what it was. And this became more pronounced after the end of the Cold War and the United States emerged as the unipolar power. And what this has actually enabled is these challenges to benefit from this global integration. And through this, they've been able to develop. And through this, they've been able to pose a challenge to the United States. And the most important power here, of course, is of China, right? So China has developed its immense manufacturing capabilities and its industrial base by gaining access to the global economy, which is a global economy that the United States sustained, right? And so within that sort of system, we see these challenges emerge within it.
You know, it's really interesting when you talk about China, because what we have certainly seen as sort of a backfiring outcome of the trade wars between the US and China is that China has really focused on self-sufficiency, hasn't it? And I think, Adam, listening to Madison, it's not just China, it's a global phenomenon where we've seen this prioritization of security and self-sufficiency, which seems to be overruling previous governments' obsession with things like global competitiveness, you know, globalization, efficiency, productiveness. What does that mean in terms of longer term interest rate settings?
So I think that's exactly right. When the Cold War finished, a lot of people talk about the peace dividend, and one of the manifestations of that was that governments were able to markedly lower their spend in that area, so they were able to take budgets back to a more balanced position. And as I was saying, that's the type of thing that lowers pressure on interest rates. And in the current world, that prioritisation that's been given to security over some economic policies, that's again a manifestation of a change in trend there. But it's not only the government spending on defence or other capex and the like that is impacting. What has changed at the heart of it is their focus. And if we think about perhaps Liberation Day last year as a good example, the US, for some of the reasons that Madison spoke about with respect to having different priorities, has moved to a system where it is prioritising internal manufacturing, internal capability, very clearly over efficiency and keeping inflation low. Any economist will tell you that tariffs are a policy that is not great for productivity, not great for efficiency and inflation. So that's a very clear example of making a change where they're stepping back from that as the objective of policy. We can see that in terms of their reference to the US dollar as well. Typically, US administrations over the past 30 or 40 years have been happy to have a high US dollar because it does lower inflation and it keeps pressure off that metric. And that means they can grow the economy strongly. This change that's come about is therefore providing investors much less confidence that the objective of the administration or the objective of governments, and we could add in France or Japan or most governments around the world, that their objective is about efficiency and keeping inflation low. And of course, if you're a bond investor, that's a very, very prime consideration for you. So they're taking the eye off the ball to a degree in terms of the things that matter to bond investors and therefore markets to a great degree. And that is seeing pressure start to come on long-term interest rates.
And certainly an incredibly important thing for bond market investors is also whether or not the central bank has credibility, whether they've let things get out of hand. And I guess it also depends on which central bank you are. Like if you're the European Central Bank, you've only got one mandate: keep inflation stable. If you take a look at Australia or the United States or some other central banks, they have a dual mandate: growth and inflation, which gets a little tricky if growth is slowing, but inflation is stickily high, like here in Australia. What are your thoughts around central bank credibility when it comes to interest rates?
So again, that question has been emerging in recent years, and probably the best example where doubt has set in is Japan. We have an economy where inflation has lifted, but it appears that the Bank of Japan is very reluctant to be lifting interest rates, and there seems to be an element of political pressure that is driving that reluctance. So we're seeing, for example, the yen weaken materially now because policy settings aren't quite right, and in confidence in inflation is very low. In the other example that has been dominating attention recent times, it's been about the US Federal Reserve.
Yeah.
And clearly, as Jerome Powell's term was coming to an end, there was a lot of noise being made by President Trump in particular about how the Fed should be cutting rates. There were court cases launched against the Fed and against Governor Cook, and it was deemed to be a threat to the Fed's independence. And so there was a great question being asked, okay, will the Fed continue to stay on the path of maintaining low inflation as a prime objective, or will it perhaps seek to appease President Trump, etc.? The good news on that front in recent times has actually been that since Kevin Warsh has come in, he has signalled a very strong resolve and a predominance of the inflation target as something that he's striving to achieve. So,
and he sounded quite hawkish, surprisingly hawkish, I think. And when I say surprisingly, because the market had thought he might pander to President Trump, he sounded surprisingly hawkish at his first meeting recently. So has the concern, do you think, been put to bed, or has it just been kicked down the road a little bit?
So the structural issues that the market looks at, that sort of general commitment of economic policy to low inflation, those question marks are still very much in play, right? Every administration will be putting priority on security and other objectives, potentially ahead of economic efficiency and low inflation. That issue remains in place. But I wouldn't say it's 100% put to bed, but it has been very good news recently that Kevin Warsh has made those noises in the right direction about sticking to the target. And we haven't heard much from Trump on the other side of the equation. So I'm going to give that a big tick for the time being. And I think it's very important. If you look at the bond market, what you do see is actually longer term rates have remained relatively contained, even though the front end of the curve in the US and elsewhere has had to reprice the outlook for the Fed. And there's been a big repricing that has occurred over a couple of months with respect to the Fed, but the back end has stayed anchored. And that is a good signal. It shows how credible monetary policy can help contain that term premium and longer term rates.
Absolutely. But if we go back to the original overarching theme of taking that bird's eye view of some of the structural issues at play that influence interest rate markets, we were talking about how governments are increasingly focused on security and self-sufficiency. So Madison, is the era of globalisation, which has helped to keep inflation and therefore interest rates low, is globalisation over?
Yes, the globalization as we understood it is coming to an end, right? And what I mean by that is this idea that you can take production and put it anywhere in the world where it's cheapest and most efficient to do that, and still maintain access to it. That's what's coming to an end. So it's not that we're going to become autarkic. We are still going to continue to engage in trade, but there's going to be strategic considerations that lay over the top of that. So we don't want to be reliant on China, for example, for our critical minerals. And so we need to find alternative supply chains, which means means duplicating them, which means inefficiencies and higher prices. But that's the price that we're willing to pay to have that strategic resource, having access to that strategic resource. So these are the sorts of considerations that are coming to dominate, which means more emphasis on security and self-resilience and less on efficiency. And so the idea that globalization, this thing that we can all engage in equally and anywhere in the world is open for us, this is what's coming to an end.
So what's taking its place? We often hear jargon like onshoring, reshoring, decoupling, de-risking, friendshoring. There's lots of stuff out there. Which one do you think would be the most appropriate for the era that we're entering now?
So decoupling and de-risking are probably the two main ones that I would sort of highlight. So decoupling is to think about these broad-based movement of economies away from each other. So Ad brought up the idea of the tariffs, right? So the tariffs against China from Donald Trump really were about this sort of broader-based moving these, on aggregate, these economies away from each other. And we're seeing this play out over time. China is dealing more with developing markets and less with the United States. The United States is dealing more with Europe and the USMCA countries and less with China. So this is a gradual long-term aggregate disaggregation, right? De-risking is more strategic, and this is when we look at things like semiconductors or the rare earths issue, right? These are looking at very strategic areas that we want to speed that process up. So these are about picking out particular industries of critical importance and having a heavier sort of policy response there. And that's because they're the areas that we think are most vulnerable.
Is it possible, though, because everything does tend to go in cycles, even longer term trends go in cycles, even if they're like a couple of decades long, is there a scenario you see where we could start to see globalization pick back up again in the global economy?
I think it will. I don't think we'll go back to an idea that the entire world is our playground, right? I think that we will start to think of other opportunities, other markets, and look at markets in a new light, just because they might be strategically or politically favorable, and that's the area that we want to sort of go to. And so there might be resources that, or areas that an economy might have that have been unexplored or untapped, just because we were available to get these from other places. But those places are becoming more geopolitically sensitive, so we might want to explore other options. I mean, we can see this with respect to, say, India and manufacturing, for example, right? So if we're not going to be investing a lot in China and manufacturing a lot of China, where are the other options? Well, India is a more politically aligned country. It's democratic. It's in part of the Quad, which is this security arrangement in the region with the United States. So maybe we want to be looking at more opportunities there.
So, Madison, in this new era, we've been getting some mixed messages out of the administration in the United States. Like, on one hand, you want, for example, President Trump talking about a weaker dollar being good, but then you also have the Treasury Secretary, Scott Bessent, talking about, no, we want a stronger dollar. In this environment, what is best for the US economy, and also what is best for the world economy?
Well, yeah, the problem that the United States is facing is that the dollar is the basis of its global power. The reason why the United States can enact such really effective sanctions, for example, is because everyone needs to deal with dollars, and if they deal with dollars, they're subject to US jurisdiction. So it wants to maintain the status of the dollar, and if we go back to the national security strategy that was released last year by the Trump administration, they explicitly say that we're going to preserve the US dollar's position as the global reserve currency. So that is an explicit goal of this administration. Of course, if you want to be the reserve currency, that's going to mean a higher US dollar, because it's going to increase demand for that dollar. And that sits really uncomfortably with this other stated ambition to reindustrialize the US and the US manufacturing industries. And this kind of goes to show the problem that the United States is facing between the privileges that it experiences in the current world order, but trying to address some of the contradictions within that. And we're seeing this play out within the United States in terms of like the social and political problems that they're having. That this is about the winners and losers of the world that the United States has built. And these winners and losers are creating a political situation in the United States that it also needs to contend with as well.
And also, do you think that the reindustrialization of America is actually bearing fruit?
Well, we do see green shoots here and there, but the point is that this is going against a broader structural problem within the global economy. I shouldn't say problem, but a structural feature of the global economy, right? If the United States wants to maintain the status of the dollar, then it's going to be running a current account deficit. And that's just the reality it needs to contend with. So it can try to put on tariffs, which haven't been particularly effective when it comes to reindustrialization. Under President Biden, we had the Inflation Reduction Act and the CHIPS Act, which were around these sort of more industrial style policies. But we're going to need to be seeing, very important structural transformation in the global economy writ large, right? If we want to see these industries come back to the United States in a significant way.
Do you think that central banks around the world are thinking about some of these big overarching themes, such as, deglobalization or de-risking and decoupling? Or are they thinking more just sort of lurching from meeting to meeting, the short-term issues at play, or maybe just looking 3 to 6 months out?
Well, they're certainly are more focused, sort of going back to that concept of the neutral rate in particular, more focused on publishing those estimates and providing that information. So that's something, for example, that the RBA has really stepped up over the past couple of years since they had the review. And it was quite notable just in the last couple of meetings, in particular in May when the RBA last lifted rates. A journalist asked, what impact does the war have on your assessment of the neutral rate? And the answer that came back was, well, if it causes a boost in renewable spending or other investment, then it's going to be putting upward pressure on the neutral rate. And we've also seen in the minutes of their discussion that they're talking about AI a lot. And for us, that's probably a big driver right now, because the pace of spending in that area is shifting so materially, and it really looks as though it's quite impervious to interest rate settings, in the same way that defence or the spend on net zero are quite impervious to interest rates. AI looks that way, and what it is doing is shifting the goalposts right in front of the RBA. So yeah, they're very focused on that.
To what degree do you feel that AI is going to be deflationary? Because we're going to be able to, at least in the labour market, potentially reduce human, and again, at the expense of humans, but it could reduce costs.
So this is something we're thinking about a lot, and effectively what we think is that there's a two-phased approach. What you've got now is this enormous spend. And as I say, that's putting pressure on inflation, it's putting pressure on capacity. There's a whole debate in Australia about data centres and whether we have the energy and the water supplies, etc., to facilitate the size of the investment that's required. While you're undergoing those discussions and while it's playing out, that puts a lot of pressure on the economy, and it causes an inflation result. Once we get further down the track of the use case of AI and that being entrenched in every organisation's operations, then it's much easier to make the case, there'll be a strong deflationary or disinflationary impact that comes through. So it might be that this element of the pressure on interest rates does pass in due course, and that we start to see a world where the potential rate of growth can lift again without putting pressure on inflation, which would be a very welcome development.
That being said, even if there is this disinflationary or deflationary impact and influence of AI over the longer term, do you think that fundamentally the target bands, Adam, that central banks like the RBA, like the Fed have, that they really, like by hook or by crook, try to stay within when they're inflation targeting, like say if it's 2 to 3%, do you think it has shifted upwards given what you've been saying about the neutral rate?
No, I don't think so. No,
so
I think in the perhaps the year around COVID or just after, there was obviously a greater tolerance to see inflation rise because we'd spent quite a long period where inflation, wages growth were very low. And that was arguably one of the mistakes the RBA made in hindsight, was taking a more relaxed approach about that idea of an average over time for inflation. So what we've seen in recent times is actually a hardening of the focus. And in Australia's case, no longer is it 2 to 3% on average that the RBA is aiming for. It is 2.5%. And with the 3 rate hikes we've seen this year, that resolve, I think, is pretty apparent. There is a recognition in the background that can cause some cost to various parts of the economy. But yeah, that's part of the price you have to pay for the long-term stability and growth that comes with that operation.
So pull it all together for us. What's the bottom line and how we should be thinking about interest rates going forward?
Yeah, so I think the picture we've been trying to outline here is one where the average cash rate over time is going to be materially higher than what it was 3, 4, 5 years ago. And that is something that investors, borrowers need to get their mind around, right? We're not going back to the lows that we had around the start of COVID. On top of that, this fight for capital that's underway, it means that there's a bit more pressure on term interest rates. So they're probably going to sit above that level of the cash rate to a greater degree than in the past. So if you want the security of borrowing for 3 years or 5 years, you're going to be having to pay a little more for that than you were previously. So the two things combined, yeah, they point to a less friendly picture for interest rates than what we perhaps became accustomed to during that period of the 30-year decline in both measures.
Well, I've certainly learned a lot today from both of you. Thank you so much. And I hope that our viewers and listeners learned a lot as well. Thank you very much to Madison and Adam.
Thank you.
But wait, there's more. Let's get a look at the week ahead in the markets with John O, international and sustainable economist at CommBank. Hi there, John.
Hey, Mandy. Thanks for having me on. So this week, in terms of in Australia, it's a pretty relatively quiet week in terms of data coming out. So all the action is going to be overseas. So on Wednesday, Australian time, we have firstly the Bank of Canada handing down their rate decision. We do think that they'll keep the interest rate on hold at 2.25% in line with market expectations. So we think that the policymakers will be comfortable to maintain a accommodative monetary policy stance. And although there is some uncertainty around the growth outlook for Canada due to US trade tensions and a shrinking population, we do think that the recovery of Canada's economy is well underway. Secondly, in China, we have the monthly data dump. We think that industrial production has grown strongly and will continue to do so on the back, especially of exports. So we think that industrial production grew at 4.5% for the year. However, the domestic story has been weak. So we think that both retail sales and fixed asset investment would have contracted. And so retail sales we predict to have contracted by 0.5% for the year, and fixed asset investment to have contracted by 5.5% for the year. And so overall, we do think that although the Chinese economy will grow, it would have decelerated in their growth. So it would have shrunk to 0.8% for the second quarter of 2026, which is down from 1.3% for the quarter. And finally, in the US, we have the retail sales data out. In May, we saw that lift to 0.8% for the month. However, in June, we do think that it would have grown at a softer rate of 0.2% for the month, and particularly driven by a fall in petrol prices. That's all the things that we have in the week ahead.
Thank you so much, John, for joining us. And thank you for joining us for this episode of CommBank View, Economics and Markets. Make a date. Hope to see you next time. I'm Mandy Drury, your podcast host. Have a great day.